For example, right now you've got China tightening bank reserves, trying to slow down, even though their money supply is still up year over year by 28%. You had Bernanke this week talk about an exit plan, as if the Fed was really going to tighten and banks are really making a lot of loans. Where's the catalyst? What do you think that next catalyst will be?
It's always impossible to predict that, Jim. There's just so many different things you can point to around the world. I mean, you could hit on a number of key ones. The currency turmoil in Europe is another potential catalyst, as is Greece. Any other country that's over-leveraged or any country that's about to default on its debt, and there are a lot of potential candidates out there. You just can't predict what the next trigger point's going to be. And, that's one of the reasons why I basically say, just continue accumulating gold. There are just so many reasons to suggest that it's going to go higher. On a relative valuation basis, as well as gold has done this decade, it's still relatively cheap. So, I can say, quite comfortably to continue accumulate it because it's not an overvalued asset. And as the financial problems continue to work their way through the system, I think people are going to come to understand more and more the importance of having money with no counterparty risk, and that's what physical gold offers.
Another area that strikes me as an opportunity, if you take a look at the price of bullion this year and you take a look at where the gold stocks are, maybe it's not quite where it was in 2008, where you had this wide gap between the performance of gold stocks and the performance of bullion. But it seems like it's another attractive opportunity because, James, as we're talking on this day, if you take a look at gold prices at $10.90, that's very attractive to a company that mines gold that isn't unhedged, and silver prices that are $16.50. That's much different than, let's say, in the fall of 2008, where you had gold fall down to that $700 level. Silver got down into the low teens. Today, at $10.90 gold companies are very profitable.
Yeah, there's another factor, too. It's the input cost. Back a couple of years ago, a barrel of crude oil cost 4 or 5 grams of gold, which is a historical high. It's now back to its historical average of about 2 grams of gold per barrel of crude oil, which means that energy costs are less than they were a couple of years ago. And just generally speaking, input costs have been pretty soft. So that's enabled the mining companies to earn greater margins. So I think the only thing that's affecting mining companies now is, for example, in Australia, because the Australian dollar had been relatively strong last year, the mining companies felt a squeeze because they were getting U.S. dollars for their product and paying Australian dollar costs. There was a similar problem in South Africa last year because the rand was so strong. So, maybe what's going to happen this year is if the dollar remains strong, although I don't believe it, that you'll see a little bit of margin squeeze on the U.S. mining companies with bigger profits earned overseas. But my view is that we're going to take out 1,200, and I think we could see 1,800, if not 2,000 this year, just simply because of all of the problems that are out there, the fact that I expect a short squeeze in gold and silver to develop, and just generally more and more people are going to understand how gold is useful in their portfolio.
All right. Well, listen, James, I want to thank you for joining us. As we close, why don't you give out your website, Gold Money, which is an easy way for individuals to accumulate gold and silver and have it stored in a safe haven.
Yeah, thanks, Jim. We're storing about $850 million of gold and silver. We can be found at goldmoney.com. You have the opportunity to store your gold and silver in London or Zurich at your choice.
All right, James, as always, pleasure to have you on the program. Have yourself a great weekend, and thanks for coming on the program.
Thanks, Jim. It's always a pleasure to speak with you.
You're listening to the Financial Sense News Hour at Financial